Welcome to my channel. I'm Scott, and in this video we're going to talk about the statement of cash flows. First, we're going to talk about the statement of cash flows on a high level, then I'll show you a basic one. Then we'll go through the direct and indirect method. We'll look at Microsoft's statement of cash flows and then a summary. The statement of cash flows is a summary of a company's cash inflows and outflows over a certain period of time. The report is usually for 1 quarter or 1 year. And people think the statement of cash flows is more intuitive than the income statement and balance sheet because it lets you know the cash inflows and outflows in 3 categories: operating, investing, and financing. A big company uses accrual accounting. So if you want to really understand the income statement and balance sheet, you need to understand accrual accounting. That's why I said earlier the statement of cash flows is more intuitive. It's just the cash movements. Say you bought a $500 Target gift card and you were to give this as a gift to a friend. Target cannot book the revenue. They have to carry it on their balance sheet as unearned revenue. They can only record revenue when it's earned. So when you give your friend that gift card and your friend goes to Target and uses the gift card, then they can book the revenue. If you own a small business and somebody bought a $500 gift card, you would book the entire revenue right away because small businesses usually use cash accounting, not accrual accounting. Same thing with expenses. You have to record them when the expense is incurred. Cash accounting is more straightforward. You record revenue when cash is received, and you record expenses when cash is paid out. If big companies used cash accounting, there will be no need for the statement of cash flows. You can just look on the income statement, because the purpose of the statement of cash flows is to convert the income statement into cash. And I'll show you examples of this later on. So a company can report a profit on their income statement and lose a lot of cash. And the opposite can be true. A company can report a big loss and generate lots of cash. Because if you look at a lot of income statements, you'll notice large non-cash gains and losses. And those types of items like goodwill impairments can really skew the net income. So here's a basic statement of cash flows. There's a Chinese restaurant in my town, Steve's Outstanding Chinese Food. And this is his statement of cash flows for 2021. He had a cash inflow from operating activities. The main way companies generate cash is from their operating activities, their day-to-day business. So this $1,000 is all the cash inflows from customer sales minus the cash outflows from all the expenses. And if a company buys or sells investments or long-term assets, that goes into investing cash flows. That was a cash outflow of $300. And if a company wants to fund its business with debt or equity or pay back debt or equity, that's in the financing section. That was a cash outflow of $200. So for 2021, Steve's business generated $500 of cash. And on the first day of 2021, he had $900 of cash. So at the end of 2021, he now has $1,400 of cash. There's 2 ways to report the statement of cash flows, the direct method and indirect method. Let's look at the direct method. We'll look at Sam's Original Candy Factory. The operating section starts with cash inflows from sales. So he generated $42,000 of cash from sales. Then cash paid out to suppliers and employees. He paid $7,000 to his suppliers and $9,000 to his employees. And then interest and taxes paid. He paid $1,000 of interest on his debt and $1,500 of taxes. So he had $42,000 of cash inflows, then a bunch of cash outflows. So he generated $23,500 of cash from his operational business. In the investing section, he purchased $22,000 of equipment. That's a cash outflow. And he sold a piece of land. He received $10,000 from that sale. In his investing section, he had a cash outflow of $12,000. In the financing section, he paid $1,500 of dividends, and he paid down $3,500 on some debt. So he had a cash outflow of $5,000 in his financing section. In the beginning of the year, he had $13,000 of cash. In all of 2021, he generated $6,500 of cash. To calculate $6,500, it's operating cash flow plus investing cash flow plus financing cash flow. So at the end of the year, he has $19,500 of cash. Let's look at the indirect statement of cash flows. You'll notice in the indirect and direct method, investing and financing look identical. The only thing different is the operating section. The operating section starts with net income, and then we have to add back all the non-cash items on the income statement. Sam had a $9,000 depreciation expense. That brought down their net income, but depreciation is a non-cash item, so we add it back here. Sam purchased a truck in 2018, and he spent $45,000 on that truck. So if we looked at the 2018 statement of cash flows, we would see in the investing section a cash outflow of $45,000. But Sam cannot report the entire $45,000 expense on the income statement. He has to depreciate the truck over 5 years. So $9,000 a year for 5 years. So that's why depreciation is a non-cash item, because the cash occurred in 2018, but then in future years, we have to add it back, because if we didn't add it back, it would be double counting. The next item is a loss on the sale of land. That was negative $2,000. We sold the land for $10,000, so it's a cash inflow of $10,000. But we actually paid $12,000 for the land a few years ago. So we reported a loss on the income statement, and that's a non-cash item, so we subtract it out here. Because say you bought $10,000 of stock in a company 2 years ago, and this year you sold the stock for $8,000. Even though you received $8,000 of cash this year, you have to report a loss of $2,000 on your taxes. Now we have to adjust for changes in working capital. You need the balance sheet to figure this out. We have to adjust for all non-cash current assets and all current liabilities. Accounts receivables went down. It went from $5,000 to $3,000. When an asset goes down, cash goes up. So we add $2,000 to the operating section. Inventory went down $1,500, so cash goes up $1,500. And if an asset increases, then it's a negative on the operating section. Some people get confused with this. Let me give you an example. Pretend the company had no inventory in 2020. And then at the end of 2021, we bought $10,000 of inventory. But we didn't use the inventory. It sat on the balance sheet. So it said $10,000 in inventory on 12/31/21. Since we use cash to get the inventory, it's a cash outflow. So that's why it's a negative when assets go up. But let's say in the first quarter of 2022, we used the inventory. We sold it to a customer. So inventory would go down $10,000 in the first quarter. Then it would be a cash inflow on the statement of cash flows. We don't care about goodwill. That's not a current asset. Accounts payable went down from $20,000 to $17,000. When a liability goes down, cash goes down. When a liability goes up, cash goes up. Pretend we had zero in accounts payable in 2020 and then $10,000 in 2021. That would be a cash inflow of $10,000. Because when you use accounts payable, it's like taking a loan. You receive a product or service, but you don't pay for it. When you actually pay for the product or service, accounts payable goes down and cash goes down. So you can see operating cash flow was the same in the direct method. Here's the direct method, $23,500, and the indirect method. It's always the same. Even though we had a net profit of $16,000, we generated more cash flow. Let's go back to the direct method. In the direct method, we can see our cash inflow from sales. We can't see that in the indirect method. In the direct method right here, we could see all our outflows from expenses. We cannot see that in the indirect method. The direct method is more useful, but almost all companies use the indirect method. It's a lot easier to generate the indirect method report because you could get all the information from the income statement and balance sheet. Regular people cannot create the direct method. Only the accountant for the company has that information. So everything else is identical. Investing is the same as the direct method. Financing is the same as the direct method. Beginning cash, changing cash, and ending cash is the same. The beginning cash, that's the cash as of 12/31 or 1/1/2021, $13,000. So if you look on the balance sheet, the cash as of 2020 is $13,000. And the ending cash is $19,500, which is our cash balance in 2021. This is Microsoft's first quarter statement of cash flows. And they use the indirect method. Their operating section starts with net income. We add back the non-cash items on the income statement. Depreciation and amortization, $3.8 billion. Stock-based compensation is another popular one, $1.9 billion. Income taxes are a cash item, but the income taxes on the income statement are not the taxes the company pays. So we have to minus out $198 million because the company actually paid $1 billion of taxes. The company pays the taxes according to the IRS, not according to GAAP. And then we have to adjust for changes in working capital. So in their operating section, they generated $25 billion of cash flow with an accounting profit of $17 billion. This is just for the first quarter of 2022. Most companies list their investing section, then their financing section. They list financing before investing, but it really doesn't matter. In their financing section, they paid down $4.2 billion of debt. They bought back $8.8 billion of stock. They paid $4.6 billion of dividends. So they had a cash outflow of $17 billion. In their investing section, they spent $5.3 billion in PP&E. They spent $19 billion in acquisitions. They also purchased and sold investments. So in their investing section, they had a cash outflow of $16 billion. If you add up the $25 billion, negative $17 billion, and negative $16 billion, that comes out to negative $8.1 billion. That's a change in cash in the first quarter. The beginning cash was $20.6 billion, so their ending cash balance is $12.5 billion, which matches their balance sheet, $12.5 billion. When a company pays dividends to its shareholders, that's a cash outflow in the financing section. But if Microsoft receives dividends on its investments, that's a cash inflow in the operating section. So when Microsoft issues new stock or buys back stock, which they did, that's all in the financing section. And the dividends they pay to those stockholders is also in the financing section. When Microsoft issues new debt or pays down debt, which they did, that's in the financing section. But when they pay the interest on the debt, that goes in the operating section. Also, if they receive interest on their investments, that also goes in the operating section. So the statement of cash flows just summarizes a company's cash inflows and outflows. It converts the income statement from accrual accounting to cash accounting. So if you want to be a much sharper investor, really get comfortable with the statement of cash flows. You could learn a lot from the company by looking at it. If you watched the video until the end, I really appreciate it. Please subscribe and leave a like. It really helps the channel. Thanks for watching.